Hello everyone, welcome back to Financial News. I'm Ron Jankowski with Channel 4 and my co-host is Paul Munichel from Ameriprise Financial. Paul's going to give us an update as to what took place in the marketplace last week and any other information, and I will, after his report, give you a report as to what is about to happen this morning or what has happened this morning from Ameriprise. So we have their notes just sent to us. So Paul, I'm going to let you take it away.
Thanks, Ron. We're looking at the Q2 earnings season, which is already looking strong so far, and it will ramp up this week. So the Q3 earnings release season accelerates this week with 80 S&P 500 companies on the docket, including 8 that are also members of the Dow Jones Industrial Average. Now through Friday, 41 or about 8% of the S&P 500's current 505 constituents had reported their results for the period. Of those, a strong 80% have reported better than expected earnings per share, while 83% reported better than expected revenues. Now, aggregate earnings per share for Q3 are now forecast at $49.90. That's up $1.20 versus where estimates ended through the quarter, which ended on September 22nd, and $2.45 higher relative to where estimates started the quarter on June 30th. Now, the blended year-over-year earnings per share growth rate for the period now stands at plus 30% on sales growth of 15%. The year-over-year growth figures are still being somewhat amplified by comparisons to the year-ago period when the economy was in the very early stages of recovery. Forward estimates, however, also continue to rise. Full-year earnings per share guidance for the S&P 500 companies are now forecast at $203, while the estimate for 2023 stands at $220. So we're seeing things in the earnings share moving, and we're expecting Q3 earnings to be reported in a positive light, and hopefully enough to keep the markets moving in the right direction. But it's like anything we always say, you got to wait and see.
I hear analysts on CNBC and various other networks all saying bright future going forward for Q4.
Hopefully. I mean, we're always could potentially be set back by anything that may spike with COVID or heaven forbid anything else, so as we know in investing, nothing's guaranteed, but the earnings forecasts do look good so far.
And what Ameriprise just sent to me is the S&P 500 futures are slightly lower this morning with the benchmark index coming off its best week since late July. So go ahead.
Yeah, I mean, we rallied at the end of the week last week, which was kind of well needed after the little bit of a pullback we've been in. So it's nice to see that.
And the yield on the 10-year Treasury is back above 1.61% as the U.S. dollar index trades near one-year high.
Natural movements.
Yep, those are all natural things to happen. Stocks in Asia, if you're a trader, traded weaker overnight after economic growth data out of China fell short of estimates, and WTI crude futures are up more than 1% to nearly $84 a barrel, and that's the highest level since October 2014. So all we're going to see is high gasoline prices.
Seems like every week, the last couple of weeks, you've been reporting oil going higher and higher and higher. And now at 84, that's the highest you've reported, I think, in a few weeks for sure.
Gosh, in a few weeks, exactly. Now, the index year-to-date returns are S&P 500 is a plus 20%, the Dow Jones a plus 16%, and the NASDAQ a plus 16% also. That is pretty solid.
Pretty solid. It was nice to get the bit of the major market recovery at the end of the week last week, but year-to-date numbers, those are still pretty staggering numbers, and we'll take them as long as we can.
Exactly. So stay with us. Paul is going to give us a topic of interest on your money. We'll be right back. And we're back with your money, and Paul's going to be talking about having money in the bank and some mistakes that you could possibly make, and I'm going to let Paul take it from there.
Thanks, Ron. And that is the topic, financial mistakes to avoid when you do have money in the bank. Because obviously money in the bank gives you some options with what you may do with it, so let's kind of dive into it. So even people who are financially secure can fall into money traps that put their future on risk or miss out on opportunities to further strengthen their financial position. So here are some common mistakes made by financially accomplished people, along with a few tips to counteract them. One is overspending. You've worked hard to get where you are, but don't abandon the budgeting strategies that help you come this far. Give your discretionary fund a boost if you must, but continue to keep an eye on what you spend each month. You can easily fall behind in your financial goals by consistently overspending in just small amounts, which add up to larger sums over time. Another mistake to look to avoid is not having an emergency fund. So if you earn a healthy sum each month and have money set aside in investments, you may not think you need other savings. However, having a workplace plan like a 401k or 403b plan or an IRA, it's not an emergency fund. Withdrawing funds earmarked for retirement prematurely can incur costly tax penalties and make you lose out on potential future earnings. Instead, it's recommended to store away 3 to 6 months worth of income in liquid savings to provide a cushion in the event of job loss, natural disaster, illness, or any other unexpected event. Next, prioritize saving for college over retirement. That's a mistake some people may have. As the cost of a 4-year degree in the U.S. continues to rise, it may be tempting to put your child's tuition ahead of your own future, yet boosting your retirement savings should probably take a priority. Your child has an array of options to potentially finance their college tuition, including job earnings, merit-based scholarships, and various loan options. When you retire, you simply won't have access to these external sources of funding if your retirement savings come up short. If you're on track with your retirement savings and want to set aside funds for your budding student, be strategic and diligent about creating a plan to achieve both goals. The next mistake could potentially be being underinsured. Take a critical look at what you own. How easily could you replace those items if an unexpected event occurs? Some standard policies may not cover as much as you think, especially if you've recently upgraded your home or added maybe to your jewelry collection. Check in with your insurance agent and upgrade your coverage as needed. If you live in an area prone to severe weather, you may be able to add a rider or flood or storm damage to your policy. Bump up your life insurance if it makes sense and review your potential need for disability income and long-term care coverage. Another thing is something Ron and I talk about a lot, failure to diversify. You've heard it a million times growing up. Don't put all your eggs in one basket. If your money is tied up in your home or in your investments and are over or underweighted in any one sector of the market, you could be on risky ground. Work with your financial advisor to evaluate your level of diversification within the context of your goals. Annual or more frequent reviews are recommended to help ensure a productive portfolio that's within your tolerance for risk. And as I always state, if you are working with a financial advisor, that's great. If you're looking for a second opinion to that advisor or you don't have one, you can always give me a call directly and we can talk through your situation. My number is 708-226-3412.
Thanks, Paul. It's something that one should really think about. You can put the money in your mattress and pack it away, and if you don't account for how much money you're taking out and spending on whatever you want and lose track of that, you'll burn right through it.
Yep, I see, or I've heard, people that do what you say. They just think they're doing the right thing by storing it in the bank, and building up in the bank. And although the money is could be very safe and secure there in their mind, it might be cutting their long-term future short because they're just not getting growth to keep up with potential inflation or any of these other things we talked about.
Or lose track of just spending too much.
Exactly, and that's why, again, you and I preach it so much. You really need to talk to someone, because the generalities we use in this show, everyone's situation is different. So you really got to figure out what's right for you.
Yep, you sure do. Well, thank you, Paul, for your topic. For Paul Municle with Ameriprise Financial, myself, Ron Jankowski with Channel 4 Retail Sites, we wish you good investment day.